Hi everyone. So we'll be starting shortly. Ashish sir will be joining soon, and initially I'll be asking a set of questions from Ashish sir, and after that, if you have any questions, please feel free to send in a speaker request. And the session would be purely educational. So any illustrations or any names taken during the conversation were purely for illustration purpose, and that should be a starting point for further study. Please don't act on that those names. Do your own due diligence and consult your financial advisor before acting on any from today's discussion. Yeah. And in the interest of time, let me reiterate, like, the questions should not be on buy sell recommendations. Please keep your questions limited to the thought process or investing framework only, because we won't be taking any stock specific questions directly. Thank you. So, welcome, Ashish sir. Thanks for agreeing to our request. And guys, let me take a moment to introduce Ashish sir. So, Ashish sir is a CIO and director of Perfect Group, basically a conglomerate which also operates a leading NBFC by the name of Perfect Finance. So, Ashish sir is BFIA, that's basically Bachelor's in Financial Investment and Analysis. He's a All India rank holder, CA, and he did his MBA from a prestigious college by the name of MDI Gurgaon. And previously, he has worked in an investment bank by the name of Goldman Sachs, and he was also part of ex Morgan Stanley, basically the equity research division. And apart from that, the Perfect Group is also involved in tax consultancy and audit services. Also manages family office, and Ashish sir is an angel investor. And basically, almost all of us are aware he's a regular speaker at NewsX, Bloomberg, Quint, Prime Spaces, and he contributes so many articles at Business Standard and Money Today, and even on sites like Money Control. And as far as what we say, I mean, philanthropy is concerned, sir is very actively involved in charity. And there is a foundation by the name of Perfect Foundation, which is feeding more than 2,000 people every day from last almost 5 6 years. That's a very commendable and appreciable job, sir. And yeah, over to you, sir.
Thank you so much, Prince. It's all the blessings and support of the society. We can proceed with the session today.
Right, sir. Thank you. So, sir, let's, I mean, give me initially, I'll be asking a set of questions. So, after 15 20 minutes, the forum will be open for questions for everyone so they can ask questions. So, to start with, sir, how did it started for you? I mean, your investing journey, and in last 2 decades, how it has evolved over a period of time.
So, Prince, basically, we belong from a Marwadi family, and my father was always investing in stocks. And this was always fascinating for me to discuss these things, even on the dinner table and otherwise. And I kind of found that very interesting that somebody is working for you and you are involved in strategy and you can be a part of any good business even though you have little capital. So that concept fascinated me a lot. And while I was doing my graduation and my MBA also, I was very clear that I wanted to build a career here. So even while I was sitting for placements during my MBA tenure, I only sat for the equity research options, trying to get a career foothold there. So, and since then, after working with a sell side firm on the uh, sell side firm on the back office side and then on the front office side, and then managing our own family office since last many years, what we realize is that since it is a passion for you, you keep learning, you keep enjoying, you keep spending time. And Twitter is such a big opportunity now for us to keep learning. So the journey keeps going on. We keep learning. We keep going through our mistakes and keep reviewing it.
Great, sir. So what is central to your investing process, sir? And in last 20 years, how it has evolved? What has kept same, and what are the areas where things have improvised or you improved your process? And yeah,
So, in terms of investment thesis or process or framework, what we did was we tried to try all investing styles, and be it special situations, be it cyclical stocks, be it cheap value stocks, so that one can make up its own mind that in terms of what is suiting oneself. Because as we always say, personalities, investing styles, there are various ways to make money. So each style can has some pros and cons, and you can make money using that style. So we spent our time going through various investing styles, practicing various things, and what we do now is we have various buckets of investing styles. So we will have some money which we'll be putting in long-term investing in terms of decadal compounders, which we think could compound for say 5-10 years. We have some money in techno funda investing, where we think, for example, the current stocks and sectors are doing well. We have some money in cyclical, so we kind of have a bucket approach there over the years. Initially, we used to try to think that there is one style, so we used to try to find that one style. Over a period of time, we realized that there is no one style which fits everybody. It is your choice, and rather than being limited by one style, we try to make buckets wherein, as per that style, we try to operate. And markets also sometimes have different opportunities for different styles. So it helps that sometimes, as Charlie Munger says, that if you are a man with a hammer, you only see everything as a nail. So if you have different tools with you, the different times of market give you different opportunities, and you don't need to sit idle. I just like to add that I forgot to give the SEBI disclaimer from myself also, that we are not SEBI registered advisors, and anything we say should not be considered as investment advice, but for educational purpose. And please consult your financial advisor before acting on it. And we may have vested interest in the stocks we discuss. Yeah, Prince, you may continue.
Yeah, sir. So, sir, if I ask you about what's the starting point when you start analyzing a company, where do you generate the idea or any screening criterias which you follow so as to,
Yeah, Prince, can you hear
I
me?
mean,
Prince, can you hear me now?
yeah, sir, I can now, I can.
I am really
Am I
sorry. I
audible to
think
you?
maybe some headset issue. I have switched on to the speaker mode.
Right, right. Sir, can you please repeat what you just explained in last 1 or 2 minutes because there were some glitches in between.
My apologies again for the listening population. Really sorry. Uh, so, can you just repeat the last question we were discussing in terms of the investment framework? I think we were talking now.
Yeah, sir. We were asking about the starting point or screening criteria or how you generate ideas for investments.
Okay. So, on the screening criteria, I would say that we use the ranking of business models framework. It's given on YouTube. So, I will not go in very detail and in depth on it. But in briefly, what I would say is that first we are looking at stocks on the basis of upside. That does the stock have the potential to generate money? Sometimes we try to avoid stocks wherein we know that they may be little to lose, but the potential to make money also is very less. So that keeping in mind that you are selecting on the basis of upside and allocating on the basis of downside. That is the core thesis of a framework, that the stock should have a large potential. Once you have identified the stock should have large potential, then allocation based on the downside probability or the downside which you see. And criteria for selection, I'll just say briefly. Otherwise, one can look at our blog, perfectresearch.blogspot.com, and also our YouTube video on ranking of business models. So, briefly, it is management, longevity, no structural headwinds, scalability, and business economics. And similarly, we have a set of desirables, which are again given on that. Uh, Prince, do you want me to elaborate on something, or we can actually take up more questions from the audience?
Yeah, sir. We can do that. We have Meet. You have any question from Ashish, sir?
Hello, Ashish bhai.
Yeah.
No. I don't have any question. I just want to say one thing. I have learned many things from Ashish sir. Be it seeing his videos on YouTube or talking with him, it's fantastic. And he is a gold mine. मतलब उनके पास इतना information है and a very deep analysis he do. And he's having a very broad framework. मतलब उन्होंने बोला कि एक इन्वेस्टर एक पर्टिकुलर स्टाइल ऑफ इन्वेस्टिंग के ऊपर ज्यादा फोकस होता है बट हिज इन्वेस्टिंग फ्रेमवर्क इज वेरी ब्रॉड बेस्ड एंड ही नोज मेनी डिफरेंट इन्वेस्टिंग स्टाइल्स So it's very important in any investor's journey कि वो अलग अलग स्टाइल सीखे और उसके ऊपर काम करे कि वो जो किस में अच्छा है उसके ऊपर वो इन्वेस्टिंग ज्यादा फोकस करे. So I've learned a lot from him. Joy, just want
Right.
to
Thank you.
thank him that
Thank
yeah
you,
that
Meet.
doing
Thank you,
good
Meet.
work
Really
for.
honored for that, and really grateful that I could help you in your journey. Uh,
Thank you, sir.
Prince Bhai, you can finish your questions and then we can open up for the Q&A.
Right, sir. Right, sir. So basically, sir, which approach you prefer the most, or it's a combination top-down approach or bottoms-up approach?
So typically, depends on the style. When you're looking at a cyclical stock, then you look at the top-up approach in terms of how the industry is performing, and then you go bottoms up. Similarly, if you're looking for very cheap value stocks, then you're running screeners, or you're looking at change in profit criteria and quarterly results, and you're looking bottoms up. When you're looking techno funda, again you're looking at top up in terms of which industries are performing. For example, in techno funda, right now banking, capital goods, auto, defense, railways are some of the sectors doing very well. So in a techno funda portfolio, what we will do is within these sectors, which are the companies we would like to own or prefer to ride these trends. So it's a mix of it. A lot of times now we realize the importance of tailwinds in the industry and the sector also doing well. It gives you a better alpha and delta. So if you use at a combination of both the top down and bottoms up approach, it gives much better results.
Right, sir. So we take one question in between. Ron, you can quickly unmute and ask your question from Ashish, sir.
Sure, Prince. Thank you for the opportunity. I think Ashish sir, you were speaking about a point where the size of the fish is not important, but the size of the pond is important. If you can just elaborate that point a little more.
Yeah,
Hello,
Rohan, you can go ahead.
was I Yeah, I was
Hello.
mentioning. I think you were talking about a point when we had a glitch where you were mentioning that the size of the fish is not important, but the size of the
Hello.
pond is more important. So if you can elaborate
I
that.
Ron, I think some issue. Ashish, sir, can you hear me?
Yeah, I can hear you.
Am I audible?
Prince, I can hear you loud and clear.
Don't know. Okay, sir. So,
Am I
so
audible
Ron
now?
is basically asking like, Ron is asking basically the size of the fish is not important, but the size of the pond is important. He want you to elaborate on that if you would like to.
Yeah. So initially in our journey, we were only looking at small caps, looking at the size of the fish. But for example, even large companies like HDFC Bank are hardly 7% of the entire or 8% of the entire banking sector, which is growing by leaps and bounds. So the other way to look at is that even though the company, the pond size is so large that it could be a shark in a pond rather than a fish in a pond.
Perhaps if anyone is listening from the perfect research team, sir can join from other handle as well if the issue is from his handle only. Okay, we can see him. Uh, Hi, sir. Yeah, sir. Yeah, better, better.
I'm so sorry. I just restarted my phone. I think Twitter app was I updated it also. Uh,
Okay, sir.
let's
Not a
let's
problem,
try
sir.
again.
So, yeah. Yes, sir. So, Ron's question you heard, right?
And yeah, I missed out Ron's question. Size of fish. I was saying that was that the question?
Yeah, yeah. He was referring to the size of the fish. You just referred, no? It could be small, but the pond size has to be large. So he was asking on that front.
Yeah. So I was just mentioning that even HDFC Bank is 7 to 8% of the entire market, and even though being a large size, there's a lot of opportunity to grow. Hello, can you hear me?
Yeah, sir. I can.
Yes, yes.
Okay.
Can you also put my wife ID also as speaker, Richa Kila, so that in case there's an issue, I will try to speak on that ID as well. She is joined. I've just joined from the other
Right,
phone.
sir. Okay, I'll search and add her, sir. So in the meantime, we take next question, sir. So
Yeah.
how easy or difficult is the small cap or mid cap space you find? What are the pointers which you look at before analyzing a company, or how to go about scuttle, but on companies for which the information available in public domain is very skewed?
See, in terms of small cap, mid cap space, a lot of times the call is on the manager or the company or the CEO or the group running it. because the biggest thing involved in a small cap is execution, which we need to see. So a lot of times when we looked at small caps, we tend to look at how hungry is the management. Sometimes small caps also do con calls, which one can look at. Sometimes reports if they have taken up debt. Sometimes the larger companies in the same sector are doing well. So you look at these various data points, wherein one each data point adds value to your analysis and the tailwind, or sometimes approvals which one would have got after years of trying, or large contracts. Those things can point you to a direction of looking at a small cap. Now, challenges would always be that since they're not very well covered, there are not many research reports on it, but one can try to look at other peer companies in the same sector to get an idea. And when you talk to other peer companies as a management, you can always talk to them about the smaller company as well in terms of scuttlebutt.
Right, sir. So, do you closely monitor the macros and how much impact or maybe the decision investing decisions have the micro environment on your investing decisions?
No, so macro in terms of whatever is relevant in terms of the particular sector of the company, that is I follow. Hello, can you hear me?
Yes, sir. I can, sir.
Yeah, so macro in terms of whatever is relevant. Hello.
Yes, sir. Go ahead. We can hear you.
Yeah, sorry. Yeah, I'm sorry. So macro in terms of whatever is relevant in terms of the particular sector or the company. For example, if we are actually investing in a bank, want to look at the macro in terms of the credit demand environment. One may look at the macro in terms of how interest rates are moving, how demand is shaping up, how the NPA cycle is playing out, how the macro has been over the last few years. So that macro is useful for us in terms of analyzing the company. But in terms of what the Federal Reserve will do in terms of maybe the rates going up or down, or in terms of so that may not be as relevant for us. So in case any action of macro is having an impact on the company or the sector we are studying, then only it becomes relevant for us.
Right, sir. So there is one question from the audience. He is asking, could you please expand on how you abstain from style drift or the tendency of investors to move from certain buckets to simply momentum investing?
So for in that case, when you classify a stock in a particular bucket, for example, if you think that the amusement park opportunity like a Vandala, which we had discussed about on a few forums earlier, could be a very long term opportunity, and we may or may not be favor in technofunda style or momentum style, then one can keep it in the long run bucket and keep that money or category different or allocation different. And similarly, when somebody is actually investing in the technofunda bucket, one can keep in mind that this money or this allocation is part of this bucket. So if you classify your in your Excel sheet or Google sheet or in your portfolio that this position is part of this style, that helps you then decide what to do, whether to buy more, hold on, or exit.
Right, sir. Sir, we talked about special situations. So there is one question on that. So basically, a pharma component and an NBFC recently got demerged. So do you have any view on that in the sense of like how one should approach such kind of situations?
So demergers, I think Neil Bhel Bhai also has mentioned a lot in terms of this thing. And there are interesting books by Joel Greenblatt, How to Be a Stock Market Genius. And similarly, other people have also put up special situations. In terms of demergers, there's a lot of technical selling which happens because of larger companies demerging the smaller entities or units, and mutual funds then dumping that stock, or bigger institutions dumping the stock, and then the stock would become very cheap. So this happened in the recent few years in terms of Green Panel after demerging from Greenply, and which gave a big opportunity. Recently, Tips Films had demerged, and they then gave a big opportunity. In terms of the pharma thing which one is talking about, one needs to keep in mind when one is looking at the valuation is what are the margins, what are the growth triggers, what is the see. One cannot just say that other companies in the same sector are trading at a higher multiple, and that's why this company should do well. One should also adjust for the growth and the return metrics while comparing with the peer companies. And even though after demerger selling might be there, but fundamentally you have to take a call on the merits of the company. One cannot just say just because the stock has fallen 30-40% from the top or listing, it has become attractive.
All right, sir. So there is one question around like there are always talks about like we should look for market inefficiencies, right? So the area of pessimism where value can emerge. So what are the pointers which we need to, I mean, look for so as to find such opportunities?
Where you think? Can you repeat the question?
So basically, where market inefficiency exists, say some good businesses not identified by a large number of institutions or maybe the niche area, basically. So, is there any specific pointers or things to look for so as to identify those
Got it.
market
Got it.
inefficiencies?
Got it. So one, as I said, that when you are looking at different styles, so if you look at the cyclical kind of stocks, for example, financials as a bucket, uh, having gone through and survived through COVID, demon, GST, and a whole host of reforms, were looking quite interesting this year. And as a cyclical, there were a lot of market inefficiency, especially on the mid cap, small cap financial players out there. We have spoken about a few financial players previously on our YouTube and blog, otherwise also. Similarly, in terms of special editions, for example, Anupam Rasayan had acquired Tanfac. That was an interesting opportunity. Or I think the CG Power opportunity everybody knew, everybody now knows in hindsight. But these management changes uh, can become very interesting. For example, recently, again, this is not a recommendation, but what we are studying is, for example, Matthew Sirak has taken a big stake in a company called Palette Technology, or as Neil Bhai had presented on Camlin Finechem, how Harsha Raghavan has taken a stake. So a lot of times, management changes can act as a catalyst. A lot of times, industry tailwinds for that particular sector. For example, in terms of currently, if you see how QSR has become such a big theme, so any players in that QSR industry could be a candidate for studying. So depending on the different investing styles, special situation, techno funda, cyclical, you need to keep looking out. Now, right now, the startups which got listed, 1 year has passed away. And you know that lock in anchor selling is also now almost over after that 1 year has happened. Now, if one might see fundamentally value emerging in those kind of businesses, they could become interesting. So because market may be looking at the short term where they're generating losses, but some of them in the future, in the long run, given the huge market share, could easily move towards higher profitability, and in the hindsight they may look quite cheap. So again, that could be an inefficiency. Hello.
Yes,
जी
sir.
जी
Yes,
हाँ
sir.
Yes, yeah.
आ रही है सर आवाज आ रही है
Let me try from
जी
this phone. I don't know, some maybe issue from
हाँ
our
हाँ
side. Let me try from this phone.
Yeah, it's clear, sir.
Yeah, please go
Yeah.
ahead.
So one question was on like, let me read it out for you, sir. So basically, i- is Indian IT sector in reasonable valuation right now, or more drawdown can happen from here?
See, first of all, there are structural headwinds in terms of US secession and what challenges are happening even in Europe. And so short term could be painful. There are talks of attrition and further layoffs. But at a certain point, a script may become very attractive in terms of valuation. Now it depends on the investing style. If one is looking at momentum, one would avoid an IT sector till it comes in momentum in terms of fundamentals and technicals. But if one is looking at deep value or one is looking at a cyclical, then at the point of maximum pessimism, one can look at these kind of opportunities also. So that is how I would look at IT sector. From a momentum style or techno funda style, I would ignore it. But from the style of a cyclical or deep value, I would keep it in mind if the valuation of a stock underlying becomes very cheap.
Okay, let's move on to next question. So, sir, one question is on cyclicals. So, basically, Anirudh ji asking ki how to identify cycles and phases of market.
Hello. So I think cyclicals, I think Jitin Parmar bhai and Nitin Dharmawat bhai have done a wonderful job. And one can look at their presentations and videos on YouTube as well. Just to add my thoughts on it, that sometimes the best time to buy cyclicals is when there's maximum pessimism in the industry, when everybody's bleeding, there talks about shutdown. That time, the people who will survive that crisis or become strong will come out stronger. So then we need to look at what companies will come out as anti-fragile from that crisis. And as the cycle turns, because cyclicals are basically on demand supply, then these anti-fragile players will benefit the maximum.
Right, sir. Sir, there is a popular opinion like don't go against the market. So, do you believe in averaging down or averaging up? What's the process you follow with your investment in terms of building position and position sizing?
See, in terms of, I would say, techno funda investing, we don't have average down at all. There is no averaging down; it's only average up. In fundamental investing, I used to always average down. Typically, now what we try to do is when a particular script is falling, if we find that the industry itself is going in doldrums or something or challenges happening, or is it the market crashing? If the market is crashing, then it makes sense for average down. So there is a very wonderful article by Bronte Capital, Bronte, Bronte Capital, on how to think about average down. So it mentions about points, for example, banking and financial stocks or leverage stocks. So if one starts averaging down, one can end up losing capital if the underlying companies goes bust. So typically, what we would do now, even in long-term investing, is prefer to average down in market crashes when scripts across the board are falling. For example, in COVID time recently, or 2018 meltdown, or 2008 meltdown, those kind of opportunities, or Russia-Ukraine crisis, which was happening, and a lot of stocks across the board were falling. Typically, an underlying stock falling, irrespective of the market, then one needs to be extremely sure that are you hands on with your thesis, because a lot of times one realizes later on fundamentally that one may have missed out certain negative points. I saw that happening in, for example, a company called Sequent Scientific, wherein the price action was clearly evident, and had one average down, it could have been sitting on huge losses, or a company like Solara or other places. So average down is always fraught with risks. One needs to be quite sure that the investment thesis is intact. That would be my 2 cents on it.
Shashank,
Yeah, yeah. Hi everyone. Hi आशीष जी कैसे हो?
Great, great. Hi, bye.
सर मेरा एक छोटा सा क्वेश्चन है कि एज अ रिटेल इन्वेस्टर वी have limited capital. So how much time generally an investor should spend on allocating more capital to a particular idea and making a reasonable return, and where the quantum of return would be higher than having, let's say, you know more ideas with you know uh, spread out capital allocation, but like looking for higher return. So do you see that by increasing allocation to certain stocks which are in the good earning phase is a better strategy in terms of risk management perspective?
See, so I think again there are different investing styles, but for example, overall we believe that it is better to concentrate on the way out rather than on the way in. So even in the fundamental bucket, rather than picking up huge stakes at the forefront, we tend to buy small stakes and then average up as the company delivers and performs on the fundamental bucket. And we prefer to have large weights as the company grows by delivering profitability, by market realizing it the potential and the price moving in our favor and the position becoming big as the money compounds, rather than taking a very large allocation initially. And similarly, in the techno funda thing, there we average up based on the price, irrespective of the uh, fundamentals or something. Obviously, if fundamentals are not intact, one may exit the company, but sometimes the price run up may be ahead of it. So both styles are different. In the fundamental bucket, one would average up based on the fundamental improvement, and on the techno funda bucket, you will average up on the price. But in both the cases, we're not taking large allocations initially, but averaging up.
Right. And when you say averaging up, is it like a specific percentage you follow? Like, for example, like your buy price is, let's say, at one. What percentage the stock has to move up, or is it like more of a qualitative decision based on the earnings profile?
So, in terms of the fundamental investing, for example, say you bought up to 2 to 3% or up to 5% of a position,
Right.
and then you can add up, say a 0.25 or a 0.5% based on some milestones which the company has delivered, or plant capacity getting set up, or further capex being announced. Those kind of things, that your thesis is playing out, or margins improving, reverting back to normal. Whatever the thesis you had in mind, that is playing out.
Right.
On the basis of that, you may average up. On the techno funder side, it is pure price momentum. So typically, what we do is every 5 to 10% we add in the positive direction. We add more position to the stock.
Right. And what's the maximum percentage you go to?
So typically, maximum we have not defined a maximum percentage. On the techno funder side, we have moving averages through which we ride the stock, and when the stock corrects, we exited one shot. So we keep averaging up. For example, recently the financials, one of the microfinance companies like Ujjivan, we have been averaging up for a long time, or a DCB. Recently, we exited Mirza, uh, wherein we thought the techno funda was giving action to exit out. But until then, we were continuously averaging up.
Yeah, yeah. I mean,
On the fundamental side, typically the runways expected are quite long. So since the averaging up is much slower based on fundamental changes in the performance, one would continue to average up as the company further. For example, the architect of the company, does it have multiple optionalities now? Is it doing sidecar investing? On what basis are you adding? There should be some criteria to it, or some uh, new thing which the company might have done.
correct.
So that on that basis, you keep averaging
Yeah,
up.
yeah. Check
On the
my question was actually, sorry to interrupt you. My question was actually what percentage of a portfolio a particular stock can be averaged up to. Like for example, like 20% of the portfolio.
So typically, techno funda we don't have any
Oh,
limits.
okay, I see.
On the fundamental side, we would say stop averaging beyond 10 to 15%.
Okay.
On the fundamental side, we won't average up beyond 10%. On the fundamental side, no averaging up beyond 10%, because there we are taking a very long term view, and we may go through big price correction or long term opportunity cost. And techno funder side, since we have technical signals to move out, there is no limit. So we have averaged up to 20 to 25% also.
Right. Okay.
Right. Thank you,
Thanks a
Shashank.
lot.
So, Nitin sir, Nitin sir,
Yeah, yeah, I'm there. Can you hear
yes, sir.
me?
You have any comment to make or any questions from Ashish sir?
First of all, I would like to thank Ashish. But before I do that, आज एक बात तो प्रूव हो गया है कि ट्विटर स्पेसेस है ना, आशीष जी की आवाज बंद कर सकता है, बट ऋचा जी की आवाज बंद नहीं कर सकता.
Thank you,
तो
Nitin bhai. Thank you for the light moment.
है ना. और आपका जो टॉपिक है विजडम एंड ह्यूमिलिटी, आई एम श्योर यू मस्ट हैव टॉक्ड अबाउट इट. Ashish and his family does lot of seva in Delhi. They have been delivering food for the needy in AIMS, RML, Safdarganj, all these hospitals. I think more than 40 lakhs lives you have touched, Ashish, right?
Yes, yes, bhai. Thank you so much
This is
for the.
this is
Uh,
fantastic. More important for me than anything else, and I'm sure that you'll continue to touch lives both in financial world as well as the people those who are in need.
Thank you so much, Jitin Bhai. Thank you for the words of inspiration.
Yeah, continue good work, yeah.
Thank you. Thank you so much, Jitin Bhai.
So, Ashish sir, like for the momentum investing, you talked about like you exit when the chart says so. But how you go about like your sell decisions, say in long-term portfolio or other methods you use?
So long term, we are more in terms of right now. If you had read Chuck Akre on an article on when to sell, or even recently Nalanda management had written a paper, Buggy Human Stack. You can read up on that on how holding on to stocks through various levels has been profitable. So on very decadal long term compounding, some of the businesses we take the liberty, and unless, as we say, the management has gone bonkers or the fundamental thesis is taken away, or management has changed and the new management is not good, or they start doing stupid things, unless the thesis is broken purely on the valuation front of point, in the long term bucket we are not selling, even if it becomes a little crazy out there.
Right, sir. Fair enough. So, sir, when it comes to quality, how much to pay for a quality? Is there any upper limit in the sense of multiples or so? How you see investing in businesses which normally keeps at premium or so?
So there are like two things also here. For example, what are your IRR expectations? So in case one is happy with, suppose, a reasonable IRR expectation, a lot of the leadership stocks, for example, like a DMart or businesses which are clearly proven as leaders, they may look expensive, but since they have a long runway, they can continue to compound for a long time, and one can then maybe adjust for derating of the P multiple going forward, given the growth opportunity could be large. But typically, what we do in terms of seeking higher IRR is basically pay up in the case where the size of the fish is quite small and the growth potential, maybe the peg ratio or whatever reverse DCF, that the company could grow for a long time and burn off the multiple in the next few years by growing fast. In that case, we are ready to pay up. Otherwise, seeking for higher IRR, we are not really paying up a lot in terms of entering the position. Once we enter the position, as I said earlier, that then we are ready to hold on to it in the long run, even if it gets crazy. So even Mangar has said that it may sound like mental accounting, that one may buy at a price which he likes, but then hold on, even if he doesn't like the price. But that is how it has worked for him, and it helps us also think about companies.
Great, great. So, any mega trends you are bullish on, and any two, three sectors which you think can do well in next, say, 4, 5 years?
So I think we are finding a lot of opportunities in the startup tech space which got listed over the last few years and really have fallen 70, 80, 90%. I won't say all of them fit the criteria, but some of them literally have great market share, are executing well. Some of them are even profitable. So that space looks interesting. The QSR space in terms of long term tailwinds looks quite interesting. Similarly, I would say uh, opportunities in terms of China plus one, in terms of setting up supply chains. Any companies playing on those tailwinds look quite interesting. So the working woman tailwind also is quite helping. So how the demographic profile is changing, or how the economic structure is changing in the world, like the China plus one I mentioned, those things become quite interesting. And the tech space which I mentioned, look at companies which have great market share and are executing well, and some of them have delayed profitability, but if the market share is intact and they can grow, then sometimes profitability is more a question of growth right now versus and reinvesting for other opportunities versus being profitable. So a lot of times we look at India as a big opportunity and say so much per capita growth can possible. But some of these platform companies, they have the potential to right to win to take most of the profits. So there one can be a little imaginative in terms of thinking of the blue sky scenario.
Right, sir. So, sir, how you see the role of mentors in investing in a good network, and how you have been able to, I mean, handle the learnings. I mean, say in the form of you must have made so many mistakes in last 20 years. Say, so what were your learnings from them, and how one can improve on the behavioral aspect in the market?
I think see market anyways is so objective. The return metrics which one is having in his portfolio, that one clearly realizes when things are not working out. So one needs to be humble and take it in the face of it. Uh, I initially was too much into the capacity to suffer kind of mindset, that let me look at very long term. Let me look at companies which may be suffering right now but doing very well later on. But then one realizes, if one is not buying before the inflection point, too early of the inflection point, one could suffer in terms of IRR, holding on to them for decades before they perform. So, role of mentors and friends and networks, especially when India market is lot of it is a growth market. In US and other developed countries, the role of moats become much more important, because you have to gain market share to grow or protect market share to defend yourself. But in India, where everything is underpenetrated and everything is growing, if you even catch the right tailwind or the right industry cycle, you can make up a lot of money, even if the company may not have great moats. So that's why these are a lot of learnings which one realizes by talking to senior investors, and allocation sizing, position sizing, riding through them. So one needs more books on Indian markets. The masterclass by super investors by Saurabh Basla, Vishal Mittal is a good attempt on profiling Indian investors. And similarly, I think Prince, what you're doing and other people are doing in terms of podcast is a great way to hear a lot of smart people and see how they are tackling this. So one needs to keep learning and evolving. It is extremely important to have sounding boards.
So, sir, if you were to name a few people who have a great impact in your investing journey, so would be great to listen from you.
See, first of all, starting from the family, I would say my entire family, especially my father. Then, in terms of MDI, my professor, Professor Sanjay Bakshi, has been phenomenal. And then there are a whole host of friends. Nitin Bhai was here, Abhinav Mansinka was here. So many friends which I have throughout the journey. I have learned as Eklavya, and they being as Dronacharya, listening to them on Twitter spaces, listening to them on conferences, so many of them. So what we try to do is try to look at what investing style we want to explore, and then look at the people out there really acing those styles. And a lot of times we are fortunate to be able to talk to them, reach out to them. I have over the last 20 years sent cold emails to so many investors, seeking out their opinions, reaching out, saying hello, saying hi, connecting on LinkedIn and other platforms. A lot of times they reply, a lot of times we end up meeting with them in these conferences. And you keep trying, keep reaching out, and benefit on those people's experiences. So I would say I have hundreds of mentors who have uh, helped me grow in terms of the investing styles. And it's difficult to name all of them. So I would say my family and Professor Bakshi would be paramount. And the rest, I would say so many of them, different depending on different investing styles.
Right, sir. So, sir, if I ask about the cash position, so how much in cash you keep at times? Like, is there any set strategy, or you are always invested? How you go about it?
So earlier we used to take cash as a position. So nowadays, even for example, my friend Abhinav Mansinka had a very interesting presentation on why you should always be invested, because timing the market requires one to be correct on the selling and on the buying itself. So we are now fully invested always, and the fundamental portfolio, anyways, we don't sell because of valuation. The techno funda portfolio automatically realigns as per the sector which is doing well. So, for example, in the recent correction over the last whatever time frame, banks, financial institutions, capital goods, autos have been doing well. So our portfolio automatically, the techno funda part of the portfolio automatically starts investing in those companies. And the fundamental long-term decadal compounders, you don't want to sell them just because the market is doing not doing well. So also think in terms of you may get 6 to 7% return on your cash investments versus the companies you're investing you could which are earning 25-30% return. And sometimes when you sell those companies, a lot of times you're not able to buy them back. So we are nowadays always invested.
Right, sir. Great, sir. So there is one question from an audience. How important is liquidity so as to make multi-baggers?
Yeah, so liquidity, especially for us investors, may not be a big challenge given our portfolio sizes and everything. It may become a concern for especially mutual funds or very large HNI investors or ultra HNI investors. But I sincerely believe that if you like a company's prospects and working, liquidity should be the least of your concerns. So ultimately, in the short run, a liquidity or low float may lead to swings in prices, wild swings. But if the company has fundamental great prospects, the market price starts moving towards that. I remember, I think when many years back, Nalanda bought into Sera, I think it hit multiple upper circuits while it bought, or even in companies like RECL Geartech, where some of the smart investors have invested money. Many such companies are there which have been illiquid. But if the company is able to execute, deliver, the company can grow in size and become more liquid. But anyways, when we are investing, we are not investing in the company because of liquidity. We are investing in the company because of the fundamental prospects of the company. And at our size, typically liquidity is not a challenge for us.
Sir, how good we are on time? Can we take another 10 minutes because we lost some time
I'm
in
sure.
between the
I'm sure.
Q&A?
I'm really apologetic to the investors that we lost a lot of time on the thing. Yep. You may please go ahead.
Right, sir. So, sir, we are seeing a trend like the shift from unorganized players to organized players and formalization of economy. So, do you see this as a mega trend and how investors can benefit from this?
See, definitely it is playing out as a mega trend. As in terms of when you see in terms of how UPI, how the formal economy is growing, even in the new generation after education, you see more and more people preferring to uh, operate in the formal economy. So as the formal economy grows, the arbitrage which a small company used to make by evading taxes or by evading compliances starts going down. So automatically the scale and size of bigger companies benefits. So unorganized to organized or formalization economy gradually starts benefiting as the entire underlying infrastructure, as the entire underlying taxation structure, compliance structure starts favoring the formalization of the economy.
All right, sir. So, one question is from Sanjay Dudeja. He's asking, like, on the PSU front, do you see a runway for PSUs from here, or it has already been priced in? How you see the PSU space across sectors?
See, again, PSUs would be something which we don't love fundamentally and would come in a cyclical bucket or tech to funda bucket. So, certain you can always find opportunities in certain PSUs which may still be cheap. For example, we were just studying a company called SJVN, I think, which is not really run up, or railway companies just a few months back were still looking attractive. A company like so you may find opportunities always in terms of general call saying that is the entire space overvalued or undervalued. There is definitely a lot of momentum in the entire space. So I would caution on blindly buying any PSU, but selectively there are always names and opportunities one can look at in looking at PSU stocks as well.
Right, sir. So, sir, I mean, especially those who are just starting their journeys or have not seen all the cycles in the market. So, basically, how they should participate in market and compound wealth. So, what's your mantra to make money in the market? What would be your suggestion to all of us?
See, I think I would always say investors think of it like a swimming pool. Dip 1 feet by doing mutual funds and indexing and mutual funds. Mutual funds, I would any day recommend Parag Parekh Financial Advisory, FlexiCap, or SBI Focus Equity, or a lot of these funds to the retail investors out there, and start thinking in terms of, do you have the temperament to actually see drawdowns in the market? Do you have the patience to see the stock going up? Do you have the interest in studying balance sheets or looking at the news flow? And do you have the time to at least give a few hours a week? If you have these four things, then start doing stock investing directly. And Twitter is a great place to learn. One can start with courses by Safal Niveshak. A friend Vishal Khandelwal runs it. And similarly, SOIC by our alumni Ishmohit Arora also is a is a place to learn. So similarly, Technofunda one can learn from Vivek Mashani Bhai, Kumar Saurabh, lot of places. So start with, I would say, basic fundamentals by Safal Niveshak and SOIC, and then start with bigger companies, blue chip companies, before delving into the small and micro cap space. So I think of it like when you get into a doctor field, MBBS, MD, DM. So build your specialization gradually rather than going on the deep end of the pool. The deep end of the pool is micro cap, small cap, loss-making companies, cyclical companies. They require a lot of experience to hold on. And maybe when you start investing in blue chips like HDFC or HDFC Bank or Asian Paints and anything, one may lose in terms of opportunity cost, but one may not lose its entire shirt or entire portfolio, because these are very high quality companies, and one can at least learn from investing and identifying these kind of companies. So just to uh, refresh and summarize, start with indexing and mutual funds. Start with courses on by renowned investors on learning. Start with uh, studying blue chip companies. There are a lot of investors who are doing advisory portfolios. You can take their services, take their help, learn gradually, and as you learn gradually, then move towards the deep end of the pool. That would be my humble submission.
All right, sir. So I have a follow-up question on this. Now, you talked about passive investing. So the performance of mutual funds is also cyclical, right? So how to go about choosing a good passive investment fund, basically? Because past performance cannot be a criteria that in future also they'll perform good. So any views on that, sir?
So our way to look at mutual funds is basically how the team has been structured, how they are thinking of investing. For example, when you look at, for example, if I take the name of Parag Parekh Financial Advisory Flexi Cap Fund, they are always looking to buy things when they go out of favor or when they're looking interesting. They don't shy away from sticking the neck out. So last few years they were buying ITC when nobody was looking willing to look at it. Now it became a momentum stock this year, or this year they've been buying stocks like Coal India or things. So I think one needs to look at fund managers who are doing a fiduciary duty in terms of buying stocks wherein the potential to make money is there, and not just replicating the index blindly in terms of the active mutual fund, not the indexing. And to your question, in terms of looking at the criteria, the team quality, their execution track record, obviously the returns generated, but what kind of stocks are in the portfolio? Are they only buying stocks like Adani stocks and all? That becomes more a momentum kind of portfolio. So one needs to start looking at that. How big is the churn? Uh, and how is the allocation size? Is it too lopsided for one particular sector? So those criteria, when you start looking at, that help you. And returns, look at the long term returns, 5 7 years, 10 years. Don't look at the short term 1 2 year returns for the selection of the mutual fund. And
Right, sir.
prefer flexi cap funds wherein you give the flexibility to the fund manager to choose multi cap style. If you only take small cap, mid cap, then you are the one restricting the fund manager to not be able to move around. So then if euphoria sets in small cap or mid cap, then one needs to take care of pruning it down. But if you give him a multi cap opportunity as a retail passive investor, the fund manager can then move around depending on where he's finding opportunities.
Great, great, sir. So, sir, any few pointers from, I mean, how to identify red flags, if people are doing some research on companies, so that would be really helpful for at least, I mean, some basic pointers which everybody can identify and stay away from investing in those companies.
So I think what we initially do nowadays is search on sites like valuepicker.com. Again, a great initiative by hello, again a great initiative to help investors. Similarly, look at keywords like frauds. Look at keywords like SEBI action. Look at keywords like tax siphoning, and search for promoters on Google and other platforms on Twitter. That is also one way to look at if there has been some action in the past. Look at the wealth creation. For example, if the stock has been listed for a long time, has it generated wealth for the investors? A lot of times, when the stock has not generated wealth for the investors, there could be hidden skeletons in the closet why the stock has not made generated returns. So, similarly, on the forensic side, on the balance sheet, P&L, look at how uh, operating cash flow is coming. Apart from the banking financial industry, companies which are generating healthy operating cash flows, paying taxes, having a good shareholding from the management, these are certain times comforting factors out there. And the absence of them could be red flags. A lot of companies just booking revenues and receivable cycle going up, and then raising debt to pay interest, pay dividends. These are all red flags.
All right, sir. So Vajpayee ji, you can unmute and ask your question.
ओके, थैंक यू प्रिंस जी। तो आशीष जी, अभी एक तो मैं जो आपने शायद स्टार्टिंग में एक स्टॉक का मेंशन किया था आपने, वंडरेला, तो ये वंडरेला हॉलीडेज के संबंध में था या कोई अन्य स्टॉक था सर?
So I think as an example, I might have taken the
हाँ,
name of as
नहीं
amusement
नहीं,
park to
कोई
Wonderla.
बात नहीं। मैं, हाँ, तो मैं ये थोड़ा सा बस इस पर मैं जानना चाहता था कि वंडरेला हॉलीडेज को जैसे आपने आइडेंटिफाई किया होगा, तो किस समय आइडेंटिफाई किया था और किस पैटर्न पर, मतलब आपने उसको फंडामेंटल के बेसिस पे किया या टेक्नो फंडा केवल टेक्निकल पे किया? एक चीज। दूसरा ये कि जैसे कंपनी लॉस में चल रही थी, तो इसका मतलब फ्यूचर का उसकी जो भी स्टडी कहीं ना कहीं से आपने की होगी फ्यूचर में, इसमें अब फ्यूचर इसका ब्राइट होने वाला है या अच्छा होने वाला है, इसी बेसिस पे आपने उसे आइडेंटिफाई किया होगा, क्योंकि इसने बड़ा अच्छा रिटर्न दिया है। तो इसलिए मैं जानना चाहता था कि इसको आइडेंटिफाई करने का मेन क्या आपका मतलब पैटर्न था या क्या क्राइटेरियाज थे, सो दैट कि मतलब उन्हीं क्राइटेरिया पर फिर आगे भी हम उसको देखने का प्रयास कर सकें कि हाँ, स्टॉक्स को किस तरह से आइडेंटिफाई करना चाहिए। एक पॉइंट सर। तो पहले सब इसी पे जरा कुछ बता दें, अगर बताना चाहें तो।
So हम लोग का एक presentation है, 4 C's of investing, where we mention about how we use cloning and then apply our checklist, capital allocation and checkout. So आप उस YouTube वीडियो को देख सकते हो. So cloning में हम लोग blindly cloning नहीं करते कि जो स्मार्ट इन्वेस्टर्स खरीद रहे हैं हम लोग वो खरीद लें, बट जो स्मार्ट इन्वेस्टर्स खरीद रहे हैं हम उसको स्टडी जरूर करते हैं. तो ये जैसे आज जतिन खेमानी जी मेरे दोस्त थे, उन्होंने एक अच्छा प्रेजेंटेशन दिया था इस स्टॉक के ऊपर, मंडला के ऊपर, मैनी इयर्स बैक. तो दैट वाज समथिंग व्हिच शोड आवर इंटरेस्ट देयर. देन व्हेन वी आल्सो सॉ कि मैनेजमेंट के बारे में हमने पढ़ा, how the father had given his kidney on donation to one of the truck drivers and generated wealth in V-Guard, a group company. So एक ग्रुप कंपनी में उन्होंने इमेंस वेल्थ बनाया है, और प्रमोटर्स के बारे में कुछ बदमाशी नहीं मिली, वेरी एथिकल प्रमोटर्स, and how not many people are able to coming in competitive intensity in this industry. So that was an interesting point, that payback period is so high, 7 to 8 years, that you don't see much competition coming into this industry. So these are the points which got us interested. And when you look at comparables outside globally, Six Flags or other players, you see that how many amusement parks are there in US and in small countries like UK versus how entertainment deficit is there in India. And even on actual visiting or seeing ratings on TripAdvisor, you would see how there has been an excellent time which people enjoy at these amusement parks and the ratings and rankings. So you can also go through a ranking of business model portfolio, wherein we have given more criterias to look at it. But scalability is one of the very big criterias, that you have a big opportunity size and the management has the right to win to grow.
All right, sir. Thank you. So, sir, one book you already talked about, the master class with super investor. Any other good literature which you would like to suggest to our attendees today?
So I would say there are a lot of interesting books which are out there. And for example, Chris Mayer's 100 Bagger is there, or the old classics, All I Want to Know Where I Was Going to Die, So I Will Not Go There by Peter Bevelin, or Poor Charlie's Almanac, or so a lot of these interesting books by Peter Lynch is there. So what I also prefer is that along with the books, please keep reading the interesting Twitter handles like Professor Bakshi's and other handles, which curate stuff for you, which give you bite-sized things, which give you a lot of interesting way to apply. So when you see the theory being applied in practice, a lot of these conferences, investing things, you see practitioners applying those concepts in selecting ideas. I think that also is very helpful when you see it in action. So I find Twitter as a big learning opportunity. These conferences, these podcasts, and things as a big learning opportunity to see theory in action and learn from the experiences of other people.
Right, sir. Great, sir. So, sir, very important question. I mean, last question from you, me. So, basically, the behavior, market behavior is one thing which is, which interrupts the compounding or building wealth over a period of time. So, what would be your suggestion so as to condition it or keeping, how to keep emotions away from investing because they are a great hindrance to good investing?
So in a lot of conferences, which I give a small example that if you're sitting in a house, if you're owning a house and the crisis comes, do you sell, say, a balcony of the house because you see the economy doing not doing well, or do you say, let me chop off, or let me give one part on rent, or let me sell one part of the house, or if I'm running a business, do you close the businesses just because the economy is not doing well or the markets are crashing? So, a lot of places we display the owner mindset in terms of our own business or in terms of owning land assets, especially when prices as a ticker is not there. So, we know we have this behavior. The same thing we need to put here while owning great businesses is my business being able to face this challenge? Is it coming out stronger? Is it anti-fragile? Please read the book Anti-Fragile from Nassim Taleb. Gives you a wonderful framework to see which companies are benefiting from the crisis. And then keep holding on to those gems because every crisis they come out stronger.
Great, great. So, sir, any concluding remarks on your part, and also would like to know how could one achieve so smiling and humility and such a persona which you have maintained quite a long.
So I would say concluding the thing is that please utilize the resources on social media to learn, connect with investors. Don't be shy. A lot of times I see people being hesitant to reach out. Please do reach out to people, and a lot of them do actually respond and give time and share the experiences. And in terms of the humility thing, see, I would always believe that market is a great humbling machine. Even life is. So it's always better to be grateful to what life has given you and understand that you are one speck in the entire universe, and your success is not dependent on your efforts, but the collective efforts of your family and society and the environment you were brought in. As Buffett says, that I was lucky to have the Ovarian lottery. So when we have so much to be thankful to God in terms of being healthy and wise and being able to take decisions, one practices gratefulness and humility comes automatically.
Great, sir. Great. So, sir, before we end, would like to, request you to talk about perfect foundation because when it comes to giving back to society, that is a great cause, and everyone should participate in any possible manner he or she can. So, anything which you want to tell the attendees so that in case if they want to get in touch or maybe so for their benefit and for the cause, if you want. Yeah.
So I would just like to request everyone that we should always be grateful to society where we have been brought and give back in whatever way. जैसे बोलते हैं, तन मन धन, whatever way we can give out to any cause, which we can give time, we can give energy, we can give contribute to any cause which appeals to us. We should do. We should not think that we need to be very big like Ambani's first to become think of social charity. Charity
Sir, I think we lost you again. I couldn't hear you.
fullness, the happiness which we have by when you get blessings from everybody to go through any crisis in life, it really completes you as a person, helps you spiritually, helps you in your investing process and business also. And as Prince mentioned earlier also, that we as Perfect Foundation, along with several NGOs, are working on multiple projects of food distribution, of running dharamshalas at various aims: Delhi, Jaja, Rishikesh, IJI, Patna, Lucknow. So these projects are with Bharat Devra Seva Nyas. Similarly, we work with other NGOs also and try to help in whatever manner, try to run, manage, raise funds. And we would like to invite you, all of you, that if you come to Delhi, if you have time, if you're in Delhi, do visit us, and it will be a great moral booster for us. It will be a great inspiring act for us. So we invite you all. My handles are there on social media, and DM is open, and my presentations do have my number also. So feel free to reach out. Look forward to hearing from you guys. And I'm really sorry for today's disruption. I don't know what challenges were there, but I'm glad that we figured out at the end of the presentation. So, real apologies from my side for the disruption in the beginning.
Great, great. So thank you so much, sir, for agreeing to our request. And as I have seen in the past, also you are very, what we say, you always agree to the causes, be it sharing knowledge or be it helping the society. So that's very kind of you, and we are grateful for that. And surely would like to have some second season of our interaction for sure. And today's session was really insightful and really interactive. And for the knowledge of the attendees, the session was recorded and the glitch part will be removed and you will properly. So I'll be placing that over my handle on my YouTube channel as well. So please feel free to revisit in case you have joined late or maybe missed on some part. So thank you again, and good night, guys.